expert voice joining us, somebody who's an American but otherwise has been in Asia for almost 25, 27 years and is seen as an Asia expert, being consulted by some of the top hedge funds across the world. Andrew Stotz from Andrew Stotz Research. He understands global markets very well, advises hedge funds across the world on their Asia strategy, and of course previously has worked with CLSA and Maybank in various parts of Asia. He's also of course a financial trainer. Andrew, good evening. Thanks a lot for your time. Right now global markets are flush with liquidity and indices in general are at record highs. At the same time, valuations to some look a little stretched and geopolitical issues are also there. How are you analyzing the global market right now?
Well, I think we have to consider the fact that the U.S. is expensive now. It's had a major run and it's been fueled by low interest rates. So that's the first kind of backdrop that we have to consider. So money has been going back to the U.S. for a long time. Emerging markets have had a harder time. But the real question is, can the U.S. continue to rise from these what I would consider very high levels as far as valuations are concerned? And that really is the question. If we can think about that, then we can understand what's going to happen in Asia in particular.
Well, Andrew, you're not alone who believe that the valuations are high. But are you, how much probability would you assign of a correction coming in because of, what's happening across the world in global equity? Then Asia could also be, coming down alongside because of stretched valuations?
So I think that the first thing is that we have to make a bet or a decision about what's going to happen with the U.S. And my conclusion at this point is that the U.S. is headed for a fall. And that fall could come, it could be 3 months, 6 months, 12 months, but the valuation's so high. And I think that it's hard to see that Donald Trump is going to be able to push that market up further through his actions. And the biggest issue that we have to contend with is the fact that the overall stock market has been driven by almost a decade of almost zero interest rates. When you have interest rates super low in any model of a stock market and valuing a company, those interest rates at a low level will cause the valuation to be high. And so also you have the issue of the government pumping money into the overall economy in America. When you pump money into the economy, you get inflation. Inflation didn't happen in the goods market, it happened in the stock market. So the biggest issue that America's faced with is they have a huge amount of government debt that's equal to the GDP of the country, and it's been financed at what my calculation is about 1.7% is what they're being financed at. And as interest rates start to rise, as the Fed is starting to do, what's going to happen is that the burden on the federal government is going to get high, plus higher interest rates means falling stock market. So those things coming together means that Trump has to really make some major moves to cause the overall market to go up higher from where it is. I think that's unlikely.
And Donald Trump has already said he would like Janet Yellen in the US Fed to keep the interest rates near zero. But, moving on from what all you've had to say, Andrew, what should be, and what according to you would be an ideal portfolio strategy? You work so closely with several fund houses in Asia. What are you recommending to them?
Well, I think the strategy that I'm focusing on right now is if there was a fall in the U.S. market, how do you make sure, because what we know in Asia is that if the U.S. falls, even if Asia's cheap and doing really well, Asia will be hit. So we have to prepare ourselves for, I would say, the next 6 months or so, that if the U.S. falls, we want to be in as much defensive countries and as much defensive sectors and markets as we can. So that's the first thing, as I'm saying, just be careful in Asia to be a bit defensive in this time. But if we were to see that the U.S. market was to come down, as I think will potentially happen, then the next question is, so if the U.S. comes down, all markets come down, the next question is what goes up first and what goes up over a sustained period of time. The U.S. is expensive, and even if it comes down, it's not going to be cheap. So I don't think that money is going to flow back to the U.S. I think that emerging markets in particular, and Asia specifically, is where there's going to be an opportunity to position a portfolio to grow over the next, let's say, 3 to 5 years. So that's where that's kind of in a nutshell, the strategy that I'm talking about.
So let's get specific. Which of those markets in the emerging markets in Asia are you referring to, and where does India feature in all of that?
So as far as India is concerned, it's one of my what I would call attractive markets. So I look at attractive versus unattractive based upon what I call my FVMR methodology, which is just looking at the stocks and the markets from 4 areas, from fundamentals, valuation, momentum, and risk. And India does come up as being a pretty attractive market, even though it's a little bit expensive, but you're getting a pretty good ROE and a pretty good earnings growth. Also, the demographics of India are so powerful with strong growth in population, and with a low level of GDP per capita, there's plenty to go. China, on the other hand, is a little bit slower growth in population, and GDP per capita has already gone up quite a bit. So I think that India has a lot of potential. As far as sectors are concerned and where to be exposed when I look across all of Asia, well, if we are really going to get a hit in the US market, that means that the market could come down 10, 15, 20%. In such an environment, you really need to be thinking about utilities types of companies, consumer companies that aren't going to be affected on their balance sheets and their income statements from a slowdown or a crash in the market. And that aren't expensive. So I would say if you look at a portfolio today and you're exposed across all of Asia, what you really want to do is you want to say, where are my most expensive positions? Where are my highest risk companies that I was willing to bet on? Those are the positions that I would reduce, right now as we go into this period. But eventually we're going to be back into high growth, high potential, because Asia is not expensive, and it's growing, and it has a potential for a decade of really strong growth.
Right. Andrew, but when we compare India with valuations in other emerging markets, then how do they stack up?
Well, that's where I use my FVMR framework as just my way of thinking about what we all know about fundamentals, valuation, momentum, and risk. And I bring them together, and I look at each country and each sector and each stock from that framework. And if we look at it from that framework, as I say, India looks attractive. We've got a little bit of expensive, but the growth is there. I think the biggest issue that I'm concerned about India, there's a couple of issues. Issue number one in India is about the bank sector and what's going to happen there. And that's the first thing that I'm concerned about, because the bank sector, if the bank sector is really damaged, that can damage an overall economy. And so what the government's response to that banking crisis, the first thing we can see is that the banking crisis is mainly at the state banks in India, not in the private banks. And so then the government has a little bit more of an obligation to get in and try to fix that than if the problem was at the private banks, where the government may be like, we're not going to bail out private banks. So I think that there's an opportunity for the government to act on these state banks to try to resolve that problem. And if they could, then hopefully lending could get back to normal. And my experience as initial days when I was in Asia was through the Thai banking crisis, leading up to it, going through it in 1997, and then how did the banks recapitalize, and how did the overall government deal with the whole banking crisis that had a 55% non-performing loan ratio, the highest in the world.
That's right. NPA is turning out to be the biggest black hole that we have in the economies. What has the investors worried? And you've already talked about how we in India and the rest of the emerging markets don't have to worry about capital outflows. So let's talk a little bit about the inflows that you're expecting, the kind of allocations that could come in from the US and Europe.
Well, the problem is that everybody's measured on a quarterly, on a monthly basis, so they're looking at their performance. You cannot, and they cannot, ignore the movement that's happened in the developed world, and particularly in the U.S. And so they've been trapped into having to be into the U.S. because such low interest rates, as I mentioned, in the U.S. and that drives a rising market. They had to have exposure. So I think that they want to come back to Asia, but they're also concerned because I like to think of Asia and emerging markets and developed markets as what I call the sink and the bathtub. The sink are the emerging markets, particularly in Asia, and the bathtub is the US, particularly the developed markets. And if a little bit of money comes out of the sink and we took a cup and we splashed it into the bathtub, it wouldn't have any impact on the bathtub, but it had a major impact on the sink that we would be shaving and doing our toothbrush in. And if money came out of the bathtub and went in the sink, it would have a huge impact. And they know that you cannot go against the flows when it comes to Asia and emerging markets. And that's the reason why they're hesitant to come. But I think that once those flows start, they're bullish on the long term for Asia.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.